Good afternoon, everyone. Thank you so much for attending NCUA Office of Minority and Women Inclusion listening session for Minority Depository Institutions. I want to just start out by saying that we are going to have an opening welcome by our chairman, Metzger. And we'll have that first, and then we'll introduce the panel.
Good afternoon, ladies and gentlemen. I'm Rick Metzger, Chairman of the National Credit Union Administration Board. Thank you for coming to this exciting event featuring a listening session on sustaining minority depository institutions. I'd also like to thank those credit unions that are currently participating in this program by self-certifying as a minority depository institution, or MDI. Today, we'll provide you a brief overview of NCUA's Minority Depository Institution Preservation Program. You'll hear from a panelist of experts, internal and external to NCUA, who assist in preserving MDIs. MDIs are predominantly owned and managed by individuals who are minorities. In other words, the majority of your current and potential members and board members are either African American, Hispanic American, Asian American, or Native American. As an MDI, your credit union plays an important role in the communities you serve because you are often the only federally insured institution serving low to middle income, underserved, and unbanked populations. Now, without your services, low to middle income consumers and businesses might have to rely on non-traditional venues to fulfill their financial needs or risk having those needs unmet. Thus, your institution plays a vital role in meeting the financial needs of growing populations of minorities. According to Filings research, minority households are more likely to be unbanked or underbanked compared to others. Credit unions lacking specific policies and programs to meet minorities' unique financial needs can learn from institutions, such as yours, that have succeeded in serving minority households. Minority credit unions reported the following engagement efforts to be most effective in serving their members. And they do this by targeting products to low-income households, attracting pricing for low-income households, providing financial education, counseling, and literary workshops, and offering bilingual services. As of December 31st, 2015, there were 625 credit unions, or 10% of all federally insured credit unions, that self-certified as being a minority depository institution. Now, these 625 institutions have 4.3 million members and $36 billion in assets. NCUA has coordinated efforts among various offices to promote and preserve these institutions. NCUA staff will share information regarding these efforts with you today. And you will also have the opportunity to hear from representatives of the African American Credit Union Coalition, the network of Latino credit unions and professionals, and the National Federation of Community Development Credit Unions. They will tell you about their work to help sustain the operations of MDIs. We also seek to obtain your suggestions on how to further enhance the MDI preservation program. I'm hopeful that it will provide an exchange of information to help us better service MDIs and help make your institutions more viable.
Again, good afternoon, and welcome to everyone who is participating virtually in this listening session that will be recorded and available for playback later. I also want to publicly thank NCUA for supporting my office, the Office of Minority and Women Inclusion, for hosting this event, and thank the chairman for his opening message. My name again is Monica Davy. I am the director of the Office of Minority and Women Inclusion. My office is charged with administering the Minority Depository Institution Preservation Program. This program was developed and established as prescribed by Section 367 of the Dodd-Frank Wall Street Reform and Consumer Protection Act. Credit unions who qualify as minority depository institutions are those that self-certify as having a majority of their members and board of directors who are a minority. Credit unions self-certify as an MDI by responding positively to 2 questions on their CU Online profile, and then by submitting that call report to NCUA. On June 18, 2015, the NCUA Board approved the final Minority Depository Institution Preservation Program Interpretive Ruling and Policy Statement, number 13-1, which details the program's objectives and goals. The purpose of the MDI Preservation Program is to do 4 things: preserve the current number of MDIs, preserve the charter of MDI in case of mergers or acquisitions, provide training and educational opportunities to MDIs, and encourage the establishment of new MDIs. OMWI publishes a list of MDIs quarterly on the NCUA website. Organizations use this list or request a custom list by ethnicity to identify MDIs they wish to partner or to do business with. The program also offers a variety of initiatives to preserve and strengthen MDIs. These initiatives vary depending on the particular needs of an MDI. The preservation efforts are provided by NCUA and trade associations, which are represented on our panel today. For NCUA, my office, the Office of Minority and Women Inclusion, acts as the facilitator to help provide MDI services and collaborate with these partners. Today, each panelist will provide information on what their particular office or organization does to assist in preserving your credit unions. Following their presentation, and most important, which is the reason why we're here today, is we want to hear from the credit unions that are participating to get ideas from you as to how we could better serve you and to raise to our attention any particular challenges that you have and sustainability so that we can come together in our collaboration to come up with particular ideas that we can use to help serve you. So I'm just going to take a few minutes to introduce the panelists that we have here today. First, we have Carla Decker, who is the president and CEO of the DC Federal Credit Union and the co-founder of the Network of Latino Credit Union and Professionals. Next, we have Rob Leonard, who is the director of the Division of Consumer Access and NCUA's Office of Consumer Protection. We next have Tim Anderson, who is the chair of the board of the African American Credit Union Coalition. Next, we have Martha Nenachuk, who is the deputy director of NCUA's Office of Small Credit Union Initiatives, and I love saying the acronym OSCUI. Pamela Owens, one of the first friendly faces I met as I entered, I'm sorry, I skipped over Elliot. Elliot Wise is the supervision analyst in NCUA's Region 3.
Yes, thank you.
And then finally we have Pamela Owens, one of the first friendly faces that I met when I first entered the credit union space at Tim's conference for the African American Credit Union Association. Pamela Owens is the Vice President of Programs at the National Federation of Community Development Credit Unions. So one housekeeping note, we want to make this conversation as engaging as possible. We have prepared information for you, but again, the objective today is to hear from you. So our panelists are going to go through and talk about some of the services that they provide to our MDIs. But more importantly, send in your questions, send in your comments, send in your challenges. To the left of your computer screen, you'll see a box that says ask questions or submit questions. To the right, I'm sorry. So please, throughout today's panel discussion, feel free to submit questions or challenges, and we will collect them and read them out and have our esteemed panelists respond to your questions. So we're going to start with Rob today to tell us a little bit about what the Office of Consumer Protection provides.
Okay, thank you, Monica, and good afternoon. My name is Rob Leonard. I'm the director of the Division of Consumer Access in the Office of Consumer Protection. The Office of Consumer Protection itself has 4 divisions overseen by the director, Gail Laster, and the deputy director, Matt Bellars. And my team, combined with the efforts of our Division of Consumer Access South, which is overseen by Rita Woods, is responsible for implementing NCUA's chartering policies. And what that would include would be new charter applications, charter amendments, expansions, bylaw-related matters, and low-income designation. With respect to how we fit into the picture with MDIs, as with any type of credit union with limited resources, we can offer assistance in 2 key areas. One area is assisting credit unions in remaining viable if a field of membership action would be to their advantage. And then the second is to provide access to resources through low-income education. So those are the two key areas that we would focus on in our office. And we look forward to today's discussion and thank all of you for giving up part of your afternoon to join us.
Thank you, Rob. Tim, would you like to go next?
Thank you, Monica. My name is Timothy Anderson. I am the chairman of the African American Credit Union Coalition, AACUC. AACUC is a group of, we were actually created to strengthen the global community, credit union community. We're a nonprofit organization of African American professionals and volunteers in the credit union industry that really just focuses on credit union involvement with African American credit unions, and particularly this subject today on MDIs really kind of is in our wheelhouse. I'm excited to be a part of this because we have MDIs in our group that are impactful in the credit union community. We believe with AACUC that we strengthen the whole credit union community with our MDIs. So clearly we have programs that we focused on since our inception in 1999, strengthening MDIs, hoping to involve as many MDIs as possible in the credit union movement. One of the things that's critical for us is mentorship. We provide mentorship. We have a collaboration with the Federation, and Pamela's here, and she'll talk a little bit about that, I'm sure. But we have a partnership where we mentor. We go into smaller credit unions, MDIs. We offer programs. We offer training. We offer just anything that we believe that can assist. Now, a lot of times it's financial, and there's a lot to talk about with capital, and obviously I think all of us would like more secondary capital, but the things that we can provide, I think they've been a lifeline to the smaller church type of credit unions. Right now we've got a program in place with our mentorship that we actually send CEOs in. CEOs from the African American Credit Union Coalition go into these organizations and we provide assistance. Now, some of that is just writing policies, just as simple as helping write policies. At times it becomes a heavy lift for those small credit unions to even have the policies required for the organization. So doing those types of training programs will help run them. Right now, at my credit union, I'm also the CEO at the Government Printing Office Federal Credit Union. We're mentoring a small credit union now. And some of those concerns that the credit unions have are just resources. And those resources at times are financial, but again, it can be helping to write the policies, helping to hire a manager. We're in the process of helping this small credit union hire a manager to run the credit union. So we're very invested with MDIs at AACUC, and again, I'm just excited to be a part.
Good afternoon. My name is Martha Ninichuk. I'm the Deputy Director of the Office of Small Credit Union Initiatives. As Monica said, SCUE is how I'll reference our office. We're truly a service facility within the agency. We are specifically mandated to assist small, low-income, and minority depository institutions. And we have a wealth of resources that credit unions really should take advantage of. And I have to emphasize this one issue: it's all free. So again, it's all free. The best way to find out about our services is visit the NCUA website. You go to the home page, you look at the service button, it does a drop down, and you'll see Small Credit Union Learning Center. And that opens up the wealth of resources. We have consulting, grants and loans. One thing I do need to mention here is grants and loans. You do have to be a low-income designated credit union, but the number of MDIs that are low-income designated are truly, it's a large overlap. I'd say about 80%. So please take advantage of that. We have a grant round coming up starting June 1st, and it closes June 30th. So please be prepared. A little disclaimer here. This is the first time credit unions will have to register on sam.gov in order to be eligible for our grant. So just keep that in mind. Don't let the clock tick too far into June before you apply. Consulting, training, we have on-demand training you can access through their website as well. And we develop a wealth of resources as far as guides on how to use your low-income designation, how to offer loan products through credit invisibles, all different types of resources that if you're an MDI and you're trying to find a way to reach your specific field of membership, come visit our website and or give us a call and ask for consulting services, which I can go into a little bit later in the program. I'll hand it now over to Elliot.
Okay. Well, as Monica mentioned, my name is Ellie Wise, and I'm a Division of Supervision Analyst in NCUA's Region 3 office in Atlanta. Region 3, we cover the southeast United States, the most contiguous states in the contiguous United States, in addition to Puerto Rico and the Virgin Islands. So we handle supervision of credit unions, the examination of credit unions. So we do, during the examinations, do provide some assistance, although during the examinations, the statistics from our region, we've got 169 MDIs in our region. And kind of along with what Martha was saying, most of them are low-income designated, most of them are smaller credit unions. And since they are smaller credit unions, we have this new examination, small credit union examination program. And with that program, we mostly focus on lending, record keeping, and other internal controls, fraud-related items. So the hours are pretty limited as far as those examinations goes to do a lot more other than our predefined, well-defined scope that we have for that examination. However, there are parts of the examination, parts of other follow-up contexts where our field staff, when they're on site, do provide some additional assistance. Each quarter, we report to Monica's office on what we do in the region as part of our supervision efforts to assist the minority depository institutions. The most recent report that we had from March, there were several areas. The most common ones were management training, so forth, Bank Secrecy Act, compliance, that kind of thing, loan administration, exam concerns, following up on those, which would spill over into mentoring and training. In addition to that, record keeping, that's a common issue. I know a couple of examiners that are very good at it that have provided several hours to new managers, assistance to new managers in record keeping training. In addition, we refer the credit unions to other resources when we're out there in the field. We may not have time. We might say that, okay, well, we'll recommend you for consulting to SCUE, in which the examiners can recommend their credit unions to SCUE for consulting assistance. In addition to that, we'll recommend them to the Federation. In one instance I can recall most recently, we had a question that came into the region about a specific loan program and setting up a 501c3 organization. We talked to them a little bit about safety and soundness. We said, well, regarding setting this up, since you are an MDI, you might want to consult with the Federation, the National Federation of Community Development Credit Unions. So we do that as well. Also, in some of our credit unions that are Latino-based, Hispanic-based, have limited knowledge of the English language. And where possible on those examinations, we try to get at least one examiner that is Spanish-speaking, either to serve on the exam team or to be the EIC, the examiner in charge of the examination. So we try to assist from the examination perspective in that manner. Also, we see in our offices mergers when things don't work out, whether one, it's a voluntary merger where the credit unions decide, well, from a strategic perspective, we're going to merge, or whatever the case might be, we're going to merge, or involuntary mergers where we're involved in selecting a merger partner. we are involved in that. Since the beginning of 2015, there were 7 MDIs that merged in our region. 2 of them merged into other MDIs. Only one of them was a non-voluntary merger. The others were they just selected credit unions that were in their specific area. that were the best fit for them. So what we do in that specific situation where we assist them with their insolvent, where we're selecting the merger partner, there's a laundry list of items that we look through that's in that interpretive ruling and policy statement that came out last year that Monica mentioned, that we go through first. We look to see if there's an MDI in the area that we merge them in the same state or nationwide, or any type of specific type. So if it's like an African American credit union MDI, then we'll look to see if there are any African American credit unions in the same city, state, or nationwide, and then we'll go to see if there's any other types of MDIs, either city, state, or nationwide. Protecting the insurance fund, lowest cost merger is always the top priority for us. But I will say in this specific situation, I had one situation late last year where I worked on a merger that was a non-voluntary merger where we went through this process. And it ended up being a win-win. We were able to merge the credit union, which was a Hispanic-based credit union, Hispanic MDI, into another one at the least cost to NCUA. So it ended up being a win-win in that situation. So those are two different ways in which we...
Oh, yeah. Can I follow up with one question?
Sure.
This is something you mentioned earlier, and it may be obvious to all the listeners, but I just want to be clear. For the small credit union examination process, it's a limited examination. MDIs that fit the definition of small automatically get that small credit union examination process?
Exactly right, Monica. It's just based on the asset size of the credit union. If you're 30 million and below, and it's based on the CAMEL rating as well. 1, 2, or 3, you'll automatically get that examination, from my knowledge. If you're 4 or 5, then there's the option involved. It's in one of the instructions that we have as far as the program goes, but you're right, it's asset-based.
Okay. Thank you. Pamela?
Thank you very much. As mentioned, my name is Pamela Owens. I'm with the National Federation of Community Development Credit Unions. We're better known as the Federation. I just wanted to give you a little bit of background of the Federation. We were established in 1974. We have a mission of financial inclusion, especially in low-income communities. We have over 200 credit unions. Our credit unions range in size from over $5 billion to under $5 million. Just in context to our conversation today, over 40% of our member credit unions are MDIs. We're very excited to be here, and especially with my two colleagues from AACUC and also from NALCUP, because we have a mentorship program which is really dedicated to MDIs and making sure that they have the resources and they have the operational support that they need to succeed.
Okay, thank you. Carla?
Thank you, Rob. Good afternoon, everyone. My name is Carla Decker, and I'm with a network for Latino credit unions and professionals. NALCUP has as its mission to link credit unions to Latino communities and vice versa. So our stakeholders are truly credit union professional leaders who are Latino, credit unions that serve Latinos or have an intention or an interest in serving Latinos, and the Latino community at large. Our role is that of facilitator. We are a membership association of sorts. We don't charge membership dues, and our annual events are free of charge. What they intend to do is to bring people together, to establish relationships, to learn about what resources are available in terms of Latino credit union leaders already within the system who have a proven track record and expertise in serving the community, to also link to other external resources and resources available through the trades and through other organizations, partnerships like the internship partnership, resources in the trades such as Coopera or other programs that are available through leagues that provide services to low wealth individuals, regulatory compliance services and things of that nature. We also have take the opportunity to really highlight what success or best practices are available. And so, for instance, at our last convening in Washington, D.C. in February, one of the programs that we highlighted was the Juntos Avanzamos, which is a national award or recognition that designates a credit union with demonstrated capacity in actually serving Latino communities. and that is a program that is now hosted at the Federation. So again, more than anything, our role is that of convener. And the reason for that is because we want to inspire credit union professionals, Latinos in particular, who are in mid-management, to meet and learn from those Latino leaders who are already serving credit unions. We also want to make sure that myths or perceived barriers in serving Latinos might be broken, and so we openly invite every credit union that is interested in serving Latinos to come to our convenings and really hear about the programs that are available, if nothing else, just the relationships that you can build in terms of finding out how to serve Latinos. And lastly, of course, the Latino community is also a stakeholder. And in that regard, the NALCA ensures that issues related to the Latino community are brought to the forefront, that we hear from legislators and reach out to regulators to create awareness for these specific challenges. We are really delighted to be able to participate in this conversation. The Latino community obviously is one that is growing, is going to be a significant, even a greater significant market in the future. And at the same time, I think that post-financial crisis, we know that the recovery in communities of color has not had the same pace or the same success as the white population, for instance. And so we think that this conversation is truly important, not just to the community, but also to credit unions in terms of an opportunity for business and to create an impact in these societies. Thank you.
Okay, thank you. So we have two questions. The first one is just to repeat some information that was stated up front, so I will answer that one, and then I'll have a question that I'll put to the entire panel. So the question is, can you repeat the information about where exactly we could find a list of MDIs? So if you go to NCUA's website, ncua.gov, if you look under the leadership boxes and go to the Office of Minority and Women Inclusion, there will be a link there for a list of minority depository institutions. Okay, and we provide that list quarterly. And there's also a report that we do to Congress that will also give you much more information about those institutions. The other question was, how do you self-certify as an MDI? And that's through your online credit union profile. There are two questions that you have to answer. The first question is whether or not more than 50% of your current members or potential members are minority. And the minority categories are African American, Hispanic American, Asian American, and Native American. If 50% of your current membership or your potential membership, based on census data, fits that category, then you check the box yes. The other question, and it's an and, it's not or, but you also must have at least 50% of your board members must be of those four categories that were just listed. Question from the audience.
No, I'm just going to comment. It's board and committees and senior management.
So the question from the audience is whether or not it's board and committee members and senior management. And there was a recent change within the last year that it's just board. Just board. Okay?
Can I bring up a
Sure.
point? Offline, before we started the listening session, we were discussing, we know there's more MDIs out there and they're not checking those boxes, and why would that be? And we faced the same situation when we were promoting the low-income designated credit unions. Credit unions were hesitant in saying, yes, I know I have low-income membership, because they thought if they would become under more regulatory scrutiny, and unequivocally you do not. So if you check that MDI box, you're just self-certifying. That does not mean the examiner is going to be at your door more often, or that the examination period is that much longer. It's just a designation or certification, and it exposes you, or you can get a lot more services because of it.
And so while we're at this point, we also talked a little bit before when we were preparing, what are the benefits to being an MDI? I think that there's some response out there from credit unions who could qualify, and their response is, well, why would I? What is the benefit for it?
So the benefits, one specifically that was alluded to earlier is consulting. When the examiner is at a credit union and they see that the credit union could need additional assistance, they do contact a SCUE. And we offer services, a menu of services on our application, such as budgeting, marketing, internal controls, record keeping, new product development. And the way that it works is either the examiner gets the credit union to apply, or the examiner nominates the credit union themselves. And then twice a year, we analyze the credit union applications and get the credit unions enrolled for a 6-month period. At that time, our consultant contacts the credit union and says, you've chosen these 3 services as far as assistance. Let's have a discussion here. Is this truly what you need? And then you enter into a conversation between the CEO and the consultant, and the examiner is informed, okay, these are the 3 services that we've decided we're going to help you with over this 6-month period. And that assistance can come in many forms. If it's marketing, then we can provide the credit union, say, a marketing plan. If it's budgeting assistance, then we can help that credit union by providing them with tools, how to develop a budget. We have videos that we can refer them to, webinars that we can refer them to. We do strategic planning where the consultant would actually come on site. So there's a wealth of services or resources. Our EDSs, or Economic Development Specialists, who are consultants, can assist MDIs with.
Anybody like to add to that?
I just wanted to say thank you so much to Martha for pointing out that it wasn't going to be additional regulatory scrutiny. In speaking with credit unions, which I know definitely should be designated as MDIs, their biggest concern was about additional regulatory scrutiny. So thank you for clarifying that.
And I'll just get on my soapbox a little bit. What you heard the chairman talk about was, in many communities, sometimes MDIs are the only form of financial services to some of these communities. NCUA is charged with preserving them. And the only way that we can really keep account of how many there are out there, what communities are actually serving, is by having access to this data. What MDIs exist in what areas. So I mentioned that one of the things that we have in our program is to encourage the chartering of new MDIs. So if we see that in potential areas, in certain areas, there aren't enough MDIs serving those particular communities, that's a place where we can actually get involved with encouraging the development of new charters.
Okay. All right. And if I may, and I'd like to say thank you to Martha as well, because clearly at the African American Credit Union Coalition, we've had those discussions with respect to those credit unions that have not self-designated, simply because they viewed perhaps additional regulation. And that's one of the things that I think leads to another point I'd like to make, and that is, and we kind of talked about this prior to, is there any sensitivity during the examination given to those MDIs? Because clearly the service area that they serve isn't the same. And there should be some sensitivity with respect to lending, delinquencies, rising delinquencies. And I hear that a lot because, again, one size doesn't fit all. And they're serving an underserved area that are going to have some perhaps problems. And is there consideration given for that?
Yeah, and there is some. The examiners I mentioned before, in a lot of cases, these are smaller credit unions, so we have this defined scope. At the same time, about 5 years ago, a letter was published by NCUA, a letter, I think it's 10CU1, supervising CDCUs and low-income designated credit unions, which the majority of these MDIs are. And a lot of that goes into the various characteristics of what is characteristic of these credit unions. How should you look at these specific items when you're at a credit union? Rising delinquencies, a little bit higher delinquencies perhaps than a credit union that is not low-income designated, that is a non-MDI. It wasn't specifically termed that in that letter because the term wasn't around officially then. But I remember being on that working group along with people external to NCUA, credit unions, were on that working group. So it was an NCUA and a credit union working group that helped develop that letter. And actually, it was a revision of a letter from 2005 that we had. So there's been, for the last at least 10 years, there's been a letter out there that said these are a little bit, this is what are characteristic of low-income designated credit unions and CDCUs. How we use it in our region, our regional director has occasionally mentioned it during our meetings that she had with our staff, that, okay, there's this letter out here, this is what's characteristic of the CDCUs and low-income designated credit unions. And additionally, I'm aware of some of the SE groups that will discuss it during their meetings. So that's how we look at it, and that's...
I'd like to follow up on that, and it's something I think all of us here have a responsibility to. Is on the other side, we need to educate the credit union managers how to have that discussion with the examiner. This is why my balance sheet looks different, and I have a strategy behind it. So they just can't say, well, yeah, that's my membership, and I'm going to have high delinquency. It's not good enough. You've got to give the examiner, some confidence that the credit union understands their field of membership, that they have their policies and procedures in place to mitigate risk. So it's an educational process. They have to feel comfortable to have that conversation with the examiner if the examiner really isn't understanding their business model.
Okay, so I have one question here that I would like for you all to take a stab at, and that is, what do you think is the primary challenge threatening the sustainability of MDIs? And is that challenge unique to MDIs?
Thank you. I think I'll answer the second part first, as I don't think it's unique to MDIs. But I think the two things that affect any credit union that has relatively limited resources, whether it just be a small credit union, a low-income credit union, or an MDI, and they're not all synonymous, in terms of that, is two things. One is having the ability to retain quality management and succession planning. And then the second is the economies of scale and the ability to offer services competitively at an affordable rate. So I think those are the two things that are, and I don't think they're necessarily unique to just MDIs. It would affect all credit unions with relatively limited resources.
Rob, I totally agree with you, but I think that there's also the issue of the economics of the market, and the fact that people of color have not rebounded from the recession as well as others have. And so, the members' finances basically drive the credit union's finances as well. So I think that there is a challenge in terms of the, and I guess there's a challenge, but there's also needs to be a sensitivity about the economics of the people that we serve.
Okay. And I'd like to piggyback on that, and certainly I agree, Carla, and Rob, certainly, and I think you make a great point there. I think it is unique to MDIs, and the challenges, as Carla stated, are enormous, and especially when you're looking at the minority population, people of color. There are, and if that's your largest membership base, then clearly it stands to reason that the credit union would be affected as a whole. So I do believe that it can be unique to those MDIs that serve that population.
And what we see in our office many times is that there's a aged CEO, and they don't have any succession plan or contingency plan if something would unexpectedly happen to the manager. We also see credit unions that are just offering basic services, so the field of membership continues to dwindle away until that credit union isn't sustainable any longer. And especially with MDIs, it's hard, for them then to find a merger partner when they've, taken those resources down to the bare minimum and they don't have any bargaining chips left in the merger agreement. So again, we try and assist credit unions to anticipate the future, to make sure that they're not dwindling away their resources, and how to bargain if they find themselves in a merger position. what they can ask as far as a merger package. So these are some of the issues that we see.
And I agree with everything that's been said so far. Succession planning is a big thing as far as like retaining management, and I've seen it from my experience as an examiner, as an economic development specialist. I was an economic development specialist for several years, and I went into both MDIs and non-MDIs at the time, and a lot of it was succession planning. Can you retract and retain someone who's been a long-time manager for 30, 40 years in the smaller credit union and pay this person what they want to be paid and the benefits and so forth? And they just, sometimes fortunately, just put their hands up and say, no, we'll just merge into another credit union. Also, one thing, and it's not as a pressing issue, but it's still an issue that I've heard more recently, is that some officials and some of the MDIs that I've seen have had an issue where it's been a Hispanic American credit union where they have board of directors that English is not their primary language, and they would prefer to get training in their native tongue to help them get their training. One was in supervisory committee training, and we had a supervisory committee in one of our credit unions that said, look, we can't get trained. We can't retain these people. They want to drop off the committee. And so we talked to NCUA at that time and said, look, is there any way that you could translate the supervisory committee training into Spanish language? And fortunately, at the time, they were in the process of doing so. So the Bell Miners came back and said, yes, we're doing that right now. It's funny you should mention that. And so soon enough, a month or so later, it came out. So I think that it's basically that and just a lack of awareness of what's out there and the training that's available.
I guess I should say ditto to everything that's already been said, but I also just wanted to bring up that one of the points about many of the MDIs that are designated right now are much smaller credit unions. Many of them are faith-based credit unions. I agree that there is a dwindling membership. One of the things the Federation has tried to do is to bring new and emerging, I can't say younger, new and emerging leadership into many of these credit unions. And we've had some successes, but it has been difficult. Another thing that the Federation has done is we've created a technical assistance hotline for credit unions. They don't have to be just MDIs, for them to call, and if there's a specific question that they have, call. We'll try to answer it, and if we can't answer it, we'll make sure we'll find an answer for you. So I think it is many of these are smaller credit unions. They have many have an older membership that are passing on. They're not the best at recruiting new members, which can be a challenge. Sometimes it's resources, sometimes it's capacity. It's almost kind of a full plan on how to sustain these credit unions, because in many instances, and I'm in New York, but our membership is national. There you can find another financial institution within, a block or two of where the credit union is at. But many of these financial institutions are not interested in the membership that is being served by these MDIs. And they still would not be able to have accounts there. So the credit union really is the only financial resource for their membership.
Okay. Tim?
And just briefly, Monica, thank you. I just wanted to just kind of follow up on Pamela's point, and clearly the discussion about the economics, it matters, because at my credit union, for example, we serve the underserved in D.C. And that area, there are banks and credit unions all over the place, but some credit unions and banks just aren't interested in serving the folk that we serve. So the economics play a part. And one of the things that we recently came up was an eviction protection program, because if folk can't pay their rent, and it's not about products and services at that point. So we go in, we do financial literacy, we do teaching how to do a budget, and if you can't teach them how to manage their money, then they aren't going anywhere for financial services. So it comes down to economics. It comes down to those that we serve, and I think it speaks to the larger question that it can and probably is unique to MDIs.
Thank you. Thank you so much. So, Rob, this is a question for you. Can you describe the profile of MDIs? Roughly what percentage are single-seg association, multi-seg, and community charters?
Sure. Thank you. I do not know the most current figures on that, but I would assume that they probably have a higher concentration of single common bond when compared to all credit unions. I think some of the more traditional forms of MDIs are the faith-based on that. The last time I looked at the numbers for all credit unions, it was about 30% community, I would say, maybe 20% single common bond, and then the rest would be multiple common bond, somewhere in that neighborhood. I would imagine for the MDIs, they would probably have slightly higher percentages of the associational common bond or single common bond due to the number that are faith-based.
And then what about federal versus state? You have any rough percentages?
We don't accumulate information for the state chartered credit unions on that by membership type on that, but I would assume the distribution would be similar. Though.
Okay, thank you, Rob.
Sure.
So this is another question that has come in from our listening audience. Can the panel please help define what they mean specifically in terms of asset size when they refer to small credit unions? Elliot, that one is probably for you.
Well, defined in our regulation, it's 50 million. It's the 100 million now? Okay, so that's right. 50, and so it's 100 million now that would be considered a smaller credit union. As far as a small credit examination program goes, it's the 50 million threshold. And when I looked at, as far as our region goes, I looked at it from the perspective of the small credit examination program because it's supervision. That's what we do. So from that perspective, I looked at it from the smaller size, like in the 30 million and below. So, but yeah, 100 million. So.
Okay. So there are two questions that are very similar here. So I'm going to read both so we can, just in case I'm missing something from one. Does or will the NCUA conduct due diligence in determining the impact of an MDI before approving a merger, field of membership expansion, or field of membership charter conversion? And I think that's the question. Both of them are kind of similar. So Rob, do you want to take that one?
Sure. I'll probably defer to Elliot on the merger part of it because our office doesn't directly. We work on the compatibility part for the field of membership, but not the merger itself. So I'll let Elliot touch on that one. But with respect to the field of membership, generally our position on field of membership is competition is good for the consumer. And in terms of that, so the more choices that they have available, the better. It's also kind of important to note, too, that there is a lot of existing competition from other types of financial institutions. Like Pamela mentioned before about how in her neighborhood there could be any number of different ones. And I'm sure they're not all credit unions. I'm sure there are other types on that. So that no matter what, they're going to have to meet, any credit union is going to have to meet the competition to become meaningful for who their members are. But certainly we do hold credit unions accountable for a community charter expansion for them to demonstrate in the business and marketing plan that they intend to serve the entire community. For example, if the area has a large concentration of people where English isn't the primary language or their most comfortable language, we would expect to see bilingual advertising and plans for that, plans to reach out to organizations in the community that can help them better understand the needs of those. So we certainly hold them accountable for that in looking at it, but generally take the position that competition generally is beneficial to the consumer.
And as far as mergers goes in our region, when we look at a merger, we'll look at to see what the paperwork is there. And as far as due diligence goes, we'll do due diligence on the credit union that's merging, but also the credit union that's the continuing one, and how they can serve this field of membership and how they can serve the members of this other credit union. So we'll look to see. One thing we mainly look at is to see how are they going to serve these members. Do they have an office facility in the area? Are they going to retain the staff of this credit union? What are they going to do? As far as the credit union, how are the members going to be treated as far as are there going to be any bonus dividends? As part of our regulation, if a credit union, say if this MDI has built this very good net worth ratio over the years and it's 15-20%, and this continuing credit union's got an 8-9% net worth ratio. Well, what are they going to do? Are they going to distribute this income to the members that they've built up over these years? What are they going to do? I know our regional director takes a pretty close look at that when these mergers come in. Per the regulation, if the net worth ratio is 5 percentage points higher, like if it's the merging credit union is a 15% net worth ratio and the continuing was at 10%, they have to describe it. They have to put that in their plan. Also, if there's going to be any financial arrangements that they're planning to pay the merging credit union's senior management, there we look at that as well. The main thing is we look to see how are they going to be served. How is this? Well, one, is it going to impact financially, preserving safety and soundness is our main goal in the region. Is a credit union going to be safe and sound after the merge with the continuing credit union? Also, in the same point, we also do look at the members. How, is this going to be best for the members? And how can this continuing credit union best serve the members? And if they've proven it well in their package, then we'll prove it. So that's how we look at it.
Okay. Anybody have anything to add to that?
If I could just.
Yeah, please.
So I agree with that, and I think that there needs to be a business case for the merger and ensuring the continuity of service to the members. Ultimately, it is ultimately we're looking out for the members. From a network perspective of representing Latino credit union professionals, I think one of the interests is also in preserving that character of the credit union and the representation, the leadership of the organization, both the professional leadership but also the volunteer leadership. And I think that when there is a merger in which the MDI leadership is lost, that the character of that new organization or the larger organization, the surviving organization, is lost to a certain extent, and that's one of our concerns.
Is that something that we consider? Does NCUA consider that as far as change in leadership or preserving leadership with the merger process?
Well, we look at it as far as not so much the board of directors. We'll look at it as far as the management. We'll look at it, and I'll say it's safety and soundness, but in some cases, like this new concept of network mergers, and I know NCUA had a webinar recently about that, which was designed somewhat to help with preserving the character of these credit unions. So there'll be this main board of directors, but then there'll also be committees from these merging credit unions that'll be there to help in guiding the new board of directors, or I should say the continuing credit board of directors, as to, okay, this is what our character is like and so forth, and helping kind of run as individual units as basically as almost subsidiaries of that. But in most cases, we'll look to see as far as what the continuing leadership looks like from a safety and soundness standpoint, but in like the network mergers and as far as the continuing when it's an assisted merger, we'll dig more deeply in as far as that goes. Like if the credit union's failing, then when we step in, and when we guide the merger, then we'll look to say, okay, are there any MDIs in the area that will help preserve this character? And then we look to see that, from that perspective, that the character will be preserved.
And that's what I was going back to, what I said earlier is we're not a compliance office but a service office. So what we try and do is before the credit union gets to that point where the agency has to actually step in and take over and do the merger process is to educate the board members what their rights are and what are their options and try to keep that the essence of the credit union intact even after the merger, how they can negotiate those terms. It's a learning process.
Pam, you had something to say?
Yes, I just wanted to echo Carla's point. I definitely think there has to be a sensitivity in terms of preserving the character and culture of the credit union that is being merged. And if there is an MDI credit union within the community, I would hope, and I understand there has to be a business model. I do understand that, but I would hope that they would be given, they would be looked at as a preferential merger partner, if such a thing can be said, because of preserving the culture, preserving that sensitivity to the needs of the community that's being served.
And just so you know, part of the rule that the board approved here at NCUA has that exact thing in mind, so that we have a preference in order that we go in. And our preference order is to try not only to preserve it as a minority depository institution, but actually match it with the community that it was serving before. So that is something that we consider. We have to balance that with the safety and soundness, but it's definitely the rule calls for that.
Wonderful.
Okay, so here I have a comment and an observation, and would love for anyone who would want to react or respond to it. It is our experience that many from the minority community are able to pay on loans with much higher debt to income ratio. However, NCUA examiners want us to never, and it's underlined, make loans to those with debt ratio over 50%. So, Elliot, I think that's yours.
Okay, I'm in the hot seat now. Okay. Is this on? It's one of these things, never say never, okay? So every situation is different, and I understand that examiners are coming in, and I've seen examination reports where they've said, you will not make a loan with a debt ratio over 50% or a credit score below 600. I've seen it before. One thing that we do as far as our supervision manuals, we'll say, okay, if we're going to tell a credit union that they can't do an activity, then if it gets to that point where, say, the net worth ratio drops below a certain level, and we say don't grant loans, certain loans under a certain credit score or above a certain debt ratio, we'll say, okay, in the document of resolution, put in there, okay, what does this credit union need to do in order to improve, in order to be able to do that activity again, to be able to grant these D and E paper, basically the lower credit quality, if you will, based on credit score paper. So, and a lot of that might be, and there's letters that come out with regards to concentration risk. What are your risks as far as that goes? So, the kind of things that we would recommend is, in that situation, maybe not saying you can't do it, never ever, but you need to set limits in your policies as far as limits as a percentage of your net worth generally, as to this is the amount we're going to keep in this kind of paper, this D and E paper. So I would say when we see that in the office, we have that conversation. Okay, can they do this again? When can they do this again? If their net worth ratio is below 7%, then they're what they call prompt corrective action. So in that case, there's some limitations there. But if it's generally a credit union that's got a higher net worth ratio, unless that net worth ratio is dropping significantly, then we can have that conversation when we develop the document, a resolution. Okay, let's take a look at this. Before you granting this, maybe you want to develop some additional policy limits as a percentage of net worth for this specific type of a little bit higher risk loan. So that's how we look at it.
I just want to follow up on that, and I appreciate, Elliot, the response. I also did want to point out that, particularly in the Hispanic community, and maybe just in the underserved community overall, people avail themselves of non-traditional forms of credit. And it's very difficult then to document those traditional, non-traditional forms of credit, because by virtue of being non-traditional, they vary the whole gamut of different types of documentation. And so I would suggest that as an advocacy, and perhaps that's not the role of NCUA, but the trades, and perhaps it is the role of NCUA from a consumer protection stance, is to maybe advocate on behalf of including some of these non-traditional forms of credit in credit reports and credit scores, whether they be rent payments or remittances or any other type of debt repayment that can be documented.
Okay. All right, next question. We're going to get to the subject of CDFIs. The question here is, what are the benefits of becoming a CDFI, and can NCUA help MDIs become eligible to become a CDFI? And so, Pam, maybe if you took part one of that question, the benefits of the program, and then Martha, could you take the second part of that, how NCUA can help MDIs become eligible?
Sure. There are a tremendous amount of benefits for credit unions that are eligible to become CDFIs. One of the major benefits is that you are now eligible for various grants that the U.S. Treasury Department makes available usually once a year, and these grants can be anywhere from, at the low end, I believe it's $100,000 to at the high end $2 million, and they can be used for shoring up capital at the credit union. They can be used for building out. If you're looking at building out another branch, I mean, there are a variety of uses. Also, for those credit unions that are in partner relationships, many times if they are looking for grant funding, one of the first questions will be, is your credit union low-income designated? Is your credit union a CDFI? There are tremendous benefits that for credit unions that are eligible, and that's why we were so excited that NCUA is helping credit unions to receive that designation.
So SCUE is working with CDFI to double the number of CDFI credit unions to 265 by the end of the year. This has been a huge endeavor by our office working in tandem with CDFI. What we're doing is we're trying to streamline the application process. What will happen is credit unions will send us their area share and loan data. We'll analyze whether or not the credit union qualifies under the target market parameters, so the penetration of loans to CDFI qualified areas. The credit unions returned the analysis and additional data from the 5300 and the 5300 profile because NCUA holds that data. So we're saving the credit union a huge amount of time and effort by doing this front load analysis first and then notifying the credit union of the results of the analysis. And the credit union then takes this information that we send back to them. They complete a shortened or a streamlined application that CDFI has developed specifically for credit unions, and then they will review, after the credit union completes the streamlined application, CDFI will actually review the application and the determination will be made that much quicker because we have the data, they trust the data that we are giving to the credit union. So we are really excited. We have obtained 12 credit unions to pilot this process. We just began that process this week. So we will bring the 12 pilot credit unions through the process during May and June, and then tweak the program where we need to, and then open up the CDFI streamlined process for the credit union industry as a whole in July. We are having an interagency webinar June 23rd for those of you that would like to learn more details. And at this time, only LID credit unions are eligible for the streamlined application process, but all others will continue to use the traditional requirements. But again, if you're interested, please join us on the June 23rd webinar.
Okay. Another question here. Our credit union operates in an MSA, Metropolitan Statistical Area, on the U.S.-Mexico border, where a majority of the population is Hispanic, and we are a CDFI, LID, CU, and MDI. We also have assets approaching $1 billion. How does a credit union our size secure relevant MDI services? So this is an LID credit union, but approaching $1 billion in asset size.
So secure relevant services? Okay, so I don't know if they're talking about for membership or from.
I think they're talking. I'm assuming they're talking about from NCUA. Are they eligible for consultant services?
Absolutely. If you're a low-income designated credit union or MDI or a credit union less than 100 million assets, those are all qualifiers. So if you're MDI approaching $1 billion in assets, you still would qualify for consulting. Of course, we would take a look at other credit unions that are asking for our assistance during a specific enrollment period. And if there are credit unions that, maybe can't afford additional services through another vendor and the credit union that's $1 billion in assets has an ability to hire somebody, they have the income available, then we'll offer our free services to that credit union that's in more need. But it does not disqualify them from our consulting services. And of course, if they're a low-income designated credit union, they're eligible for our grants as well.
Okay, next question. What opportunities may MDIs have to reach millennials, especially in view of millennials desiring non-traditional financial services? Anyone like to take a stab at that?
I'll go first. So in the Latino population, the median age is 28 years old. So if you are serving Latinos, more than likely you already either have within your membership a large proportion of millennials, or within your potential field of membership, you have a large proportion of millennials. And then in terms of linking to your services, I think it goes back to the question of challenge and capacity, because clearly a smaller credit union, $100 million or less, would need to make significant investments in being able to provide e-services or services that are relative, services that are relatable to a young person, including some of these non-traditional, I guess, banking products and services. The good news is that there are opportunities to learn from others. There are best practices and there are resources, starting with the Federation, and I don't want to take away your thunder, but the Federation and an opportunity to avail themselves of data processing services at a fair price that are suitable for extending services, filing research, and then literally just, I guess, reaching out to other credit unions in the marketplace that are successful at serving millennials. And that's why we say that's the role of NALCUB in terms of just being a facilitator or a convener for these types of credit unions.
I think that this is an incredible opportunity to engage millennials in a variety of ways. One is through, we were just talking about the credit union being a little bit older of a movement, and this is the opportunities to engage millennials not only as members but also as employees. One of the things that, as I mentioned before, the Federation has tried to do is to bring younger people into the credit union movement, not just in a teller capacity, which is very important, but also in terms of a management capacity for at credit unions. In addition, we were looking at a study, which I think was by Filene, which said millennials really want to be involved, and while they're very much interested in the services, they also want to be a part of something bigger. And I think that the credit union movement is such a great fit for being part of that something bigger, making a difference, and especially looking at some of the communities that our credit unions serve. But in terms of products and services, I think that millennials don't like fees. They really don't like fees. We have credit unions that are doing fantastic with so much no-fee products and services. So, doing a white paper on kind of how you reach this group and how you do it without having fees is a great opportunity to share knowledge. So I think there are just so many different levels to engage millennials. But what I encourage you to do is to actually engage them. I think that we discuss a lot about how important it is. I don't know if we're actually doing it enough. And I also wanted to give a plug to the NCUA grant program that's going to open on June 1st, because one of the opportunities is for student internships, and that is so important. So incredibly important. And this might be an opportunity to engage a millennial working at the credit union.
Okay, Martha, this is your chance.
This is my chance. Thanks, Pam, for the plug.
No problem.
We've had some great stories coming back from credit unions that have had interns assist them developing web pages, helping them with their marketing plans, developing, phone apps, just really incredible stuff. Also, developing association boards where they consist of young individuals that keeps the board of directors more on point of, hey, what does this younger generation really want and need? Really interesting dynamic between the two types of boards, so that's great. But back to our grants. Internships, we have up to $4,000 available per credit union that applies and would become an applicant. We also have training, so training for board members, your governance leaders, official families, that's up to $3,000. Cybersecurity, which is a huge issue for all credit unions right now. This grant initiative will assist a credit union supporting or enhancing their cybersecurity software and programs and protecting member information. That's up to $7,000. And then our last grant initiative for this period is capacity and growth. This is an initiative where for credit unions wanting to implement a new loan or deposit product or implement a growth strategy for greater outreach to their membership. And that's up to $15,000 per credit union. So that's our largest initiative.
And if I may, and certainly I agree with Pamela, and thank you, Martha, for sharing those programs and the information on grants. At AACUC, we believe in engagement as well. We have to involve the millennials, and we have. At our conference last year in Philadelphia, we established, right after we came out of that conference, an advisory group of millennials. And I became the new chair last year, and if I heard it once, I heard it 1,000 times, and that is, we want to be involved. We have ideas. And so we've got millennials that we want to just not only come up with programs, but we want to hear from them. What do you want? And that process has been going on, and we're really pleased with that. But also with our internship program. It's one of our signature programs at AACUC. We have HBCUs around the country that we place students at credit unions throughout the country. We've got large credit unions over $2 billion in assets, and as small as a couple 100,000. So we believe that obviously the millennials have replaced us, the baby boomers, as the largest segment. So our focus at AACUC is simply, what do you want, and how can we deliver it?
Okay. All right, I have one more, and yes, the CDFI question. If a low-income CDFI is privately insured, how are they listed or found on the website? That's all I have, so I don't know
I don't understand that.
Context of that.
No, they're not.
They're not listed on the website. Okay, so hopefully, I mean, that's a simple answer. They're not listed on the website if they're privately insured. Okay, we're going to move on to a topic of field of membership. So, Rob, you're probably going to take a stab at this initially.
Sure.
Are MDIs changing charter types or trying to expand their field of memberships? And then this is the second part of this. Would MDIs be helped if the proposed field of membership rule from NCUA is finalized?
Okay. Yes, I would say quite often we do see interest among MDIs in expanding their field of membership. Probably the most common that we see are community charter actions on that, and we have seen quite a few on that where credit unions, where they're serving a majority of minority population, where they want to expand and get further outreach. So we do see quite a bit of that. And I think the new rule, if it goes through as anticipated, will help all credit unions. So it would certainly also give more opportunities for minority credit unions as well as all others. So.
Any other comments or feedback on the field of membership rule and its impact on MDIs?
Thank you. And we were having this conversation prior to, and one of the things that I believe, and I hear from credit unions at AACC, MDIs, we all want and we embrace the field of membership expansion. It's going to be good for everyone. However, are there unintended consequences that if you expand this growing, ability now to go into areas that were predominantly served by MDIs, is there an unintended consequence that could adversely impact the MDI? Now, again, and we were talking about this, Rob and I, and we believe choices are good, and so as many choices as members have, then that's going to be good. But however, there is some concern that it could have unintended consequences.
I did want to say, and I know there, with the part of this new rule for multiple common bond credit unions that can use the internet as an option for a service facility, if you will. The thing that I remembered also reading when I looked through this is that I think that, and Rob can correct me if I'm wrong, for a credit multiple common bond that wants to add an underserved area, that service facility requirement hasn't changed, right? It's not internet. It's still like a brick and mortar facility that has to be in the area.
No, could I please? Sure. Thank you. No, I mean, it would basically, the internet would be, as envisioned under the new rule, that is proposed, I should say, the internet would be the facility on that. Now, for an underserved area, no, that would not change.
Right.
Okay. If I understand, right. The underserved area for that, it must be a brick and mortar facility.
Okay.
On that for a multiple common bond credit union and underserved, because we've interpreted that as a statutory requirement. So yes.
Oh, thanks.
So there is one more specific question here, and you may have answered it, but I'm just going to read it just in case. Would MDIs benefit if community chartered credit unions could add underserved areas to their field of membership? Can this be done by regulation, or does it require a change in statute?
Okay. To answer the question, yes, I think it would benefit underserved areas immensely, because it would increase the pool of credit unions that would be eligible to add underserved areas. So yes, and indeed that would be an enormous help. That is, however, a statutory change on that, because Congress would need to act on that, because the Federal Credit Union Act explicitly limits the ability to add underserved areas to multiple common bond credit unions. So it would be a statute. It wouldn't be within a regulatory program.
Okay. So this question, it kind of goes to the conversation we were just having about balancing, preserving MDIs, but also acknowledging choice for consumers. What is in place to allow MDIs to become or remain competitive when there are so many larger credit unions that engage in the same community, in which they lose their membership participation to the credit unions that offer more? So what is in place to allow MDIs, or I guess we could even say for smaller credit unions, to become or remain competitive when you have those larger credit unions out there that just can offer more to their potential membership?
That's a difficult question. I was a credit union manager at a faith-based institution for many years, and it all boils down to, I think, the type of service that you offer your member. Is it quality service? Is it high touch? You know, are you offering the products that they're looking for? If you can deliver in that manner, you just hope that you attract or maintain your membership and continue to grow. But competition is tough.
Pam?
You know, I think that's a very difficult, that's a challenge that many credit unions face. And I think back to one of our credit union members, a faith-based credit union that a larger credit union with more resources and more products and services opened a branch in their community, and they thought they were kind of a goner. And they found that their membership actually increased because their members were very high-touch members with very challenging credit histories. And this credit union, within the limits, was able to work with them and develop products and services. So even though the other credit union did have more products and services, their members really liked more of that high-touch service and needed more of that high-touch service. And they also developed products and services that were very specific to that community, where credit scores were very challenged. A lot of people were getting back on their feet, and there was a lot of loyalty to the credit union that was able to helped them when they were at a very difficult time in their financial lives.
If I could just add that engagement, relationship is key in this case, and you deliver that through products and services. You also leverage partnerships. Wherever there are aggregators of that MDI community that can serve as your referral, that can serve as that link in the relationship between you and the consumer, that's where the difference also lies. And so I want to give two very quick examples. And one is we provide financial services to members of Casa de Maryland, and they provide legal services, immigration services to their own members. And we as the credit union provide the financing for those immigration applications. It doesn't, competition is then obliterated. No large bank, no fancy financial institution actually will finance these, $600 loans. Likewise, we bank the participants of the city's summer youth employment program. And this year alone, we have banked 700. And so if you talk about attracting millennials and how do you engage them, again, it's through these very specialized services, being there with products and services that are relevant, but also having that partner that basically opens the doors and makes that introduction. Is very important.
Okay.
And if I may, I'll just piggyback on that and certainly agree that, and I can remember back, and I'll use the four-letter word, in my banking days, community banking, we had to differentiate ourselves. We did it better than others, and Martha's right. That's a tough one because competition is competition. So our view is that we're going to differentiate ourselves, and we're going to do this better than the big banks. And I think in credit union world, it's the same thing. As Carla just mentioned, there are services that we provide and products that we provide that others won't. So again, we've got to find our niche, and then I think that's how you compete. That's how you retain your members, and your members will want to stay with you.
Okay, we have about 10 minutes left. What I'm going to commit to for my office is that for those questions that we were not able to answer, that we will publish answers on our website for the questions. We just want to make sure that while we have time left, that we solicit input from the audience as to what we can do to make the program better. So keep sending them in, questions as well as suggestions. But there's one here. Is assistance available to credit unions that are not interested in a merger, but lack financial resources to grow their membership and are strategizing to serve low-income and underserved communities? I think that's for Martha.
Absolutely. You would contact our office through our website, fill out a consulting application form. Do it before the end of May because we're starting our next consulting round as of July 1st. But yes, a consultant would be available to come out to your credit union and discuss with you a marketing strategy, an outreach strategy, look at your products and services. Are they priced correctly? Are you offering the right types of products? So we can help you build an overall business plan.
I remember when I first came on board and when I met with Martha and Bill, just trying to understand the concept of the small credit union, I asked them, doesn't every credit union want to be larger? And their answer was no.
No, right? Absolutely not.
Right.
They have a specific business model. They have a specific field of membership. They do a great job in providing financial services. So they have their business model in mind.
Okay, so with Pam, I'm sorry, she wanted to add something.
Well, I just wanted to, again, give a shameless plug to the My Credit Union Mentor Program, which is a collaboration between AACUC and NALCUP and the Federation. This might be an excellent opportunity for that credit union or any credit union to engage with a mentor about serving a minority community. We have credit union professionals that have signed up to serve as mentors for short-term and long-term assignments, and this might be the exact kind of opportunity to work with the credit union.
Pam, can you address, we talked about this a little earlier, the credit union, the small credit union or the MDI or LID that fears the mentor relationship because they believe that there's some intent to take them over. Can you address that?
Sure. I mean, I think that many of the smaller credit unions are a bit fearful that if a mentor comes in, they're actually looking to merge in that smaller credit union. One of the things that we've said is this is a mentorship, but it's also a partnership, and that if it is a person from a larger credit union that's coming in, they're truly coming there with a specific skill set, strategic planning, marketing, accounting, operational expertise, and they're coming there to help. That is something that we have drilled into our mentors, something that they have signed up for and said, this is not about merging in, this is about helping. This is a credit union movement, and one of the things that has kept me in the movement for so many years has been how collaborative it can be, and I think this mentorship program that our three organizations work on really shows that collaboration and that partnership.
Thank you. So we're going to take this last question, and I'm not sure who the proper person is to answer it. I think there's someone in the audience that probably could, but I won't put him on the spot. Can you address the regulatory burdens MDIs currently face? And I think the question behind that is probably, is NCUA focused on that, reducing regulatory burden, and particularly with respect to MDIs?
Well, I think we hear it from MDIs and from non-MDIs of the regulatory burden that's out there. I'm not going to, say anything about what potential regulatory burdens are that we might be thinking about reducing it on, but there are a couple out there. And I know some of them were started under the prior chairman and are being continued under the current chairman regarding the field of membership-related issues. Also, there's a final rule that was just passed regarding commercial lending. That's going to ease the regulatory burden for those MDIs, those low-income credit unions that do commercial lending, where it's going to make things, as far as having to get a waiver from our office on, say, a personal guarantee on a member business on a commercial loan, or say you want to grant a loan to somebody that's got a high loan-to-value ratio on a commercial loan, well, they don't have to get that waiver from us. However, there are going to have to be some policy and procedure-related issues that are going to have to be more stringent from that perspective. So reducing the regulatory burden from that perspective, also from the perspective of the field of membership-related issues. As far as any future ones, I can't comment on that. You invite other office.
I would just like to add that the board has been very consistent about expressing their desire to reduce burden to the extent that we can as an agency. Certainly, where I deal mostly was with the field of membership aspects of it, but the board has, again, with all the changes, been very sensitive to that.
Okay, thank you. Martha, we have two quick CDFI questions that I think you may be able to hit quickly. Is the streamlined CDFI application process available now?
Well, we're just at the pilot period, and we have our limit of 12 credit unions already designated the pilot. So the streamlined process will open officially in July for the remaining credit union community.
Okay, and if I understand this question correctly, you may have already answered it, but just bear with me. The CDFI certification process has changed, forcing more frequent recertification. Is the streamlining assistance for MDIs available for recertification as well as initial certification?
Great question. We're not there yet. This is our first attempt. This is I'd say, phase one of our partnership with CDFI, and that is to do the streamlined application. Next up, we hope to look at recertification.
Okay, so the last four questions I have here are really about suggesting how we can make our program better. So I'm going to reserve those questions and we'll publish some responses. But in closing, I just want to thank everyone who is participating virtually in this listening session today. We are pleased you were able to join us to learn more about the MDI program and the services provided by NCUA, the African American Credit Union Coalition, the Network of Latino Credit Union and Professionals, and the National Federation of Community Development Credit Unions. We appreciate the opportunity to hear directly from you and to learn about the challenges facing your organizations. We know this will help us all serve you better. I would also like to thank each member of our panel for coming to share with us today and for their dedication to serving MDIs. Immediately following the session, you will receive a survey by email requesting your feedback and offering an opportunity to indicate your interest in serving as a mentor to an MDI or being mentored if you are an MDI, partnering with a failing MDI to preserve the MDI's minority character, or partnering with an MDI to help them provide a particular service, such as loan participations for vehicles or mortgages or debit cards. Again, we value your contributions today and look forward to working with you in the future. Thank you again for your time and attention to this important program.